This is the fourth time I've come to speak to IHMC. I've spoken twice to their group in Pensacola, and then this is the second time in Ocala here. Have any of you seen me before down here? All right, I don't know really what to make of that. I must have made a great impression on that last talk. So again, thank you for coming tonight, and I promise to make it worth your while. What we're going to talk about tonight is the stock market, and I'm going to break it down really in kind of two pieces. The first piece, I'll talk a little bit about what my firm is seeing in the market right now, what we think, is it a bull market, bear market, is it ready to correct, et cetera. So we'll be looking at the market using two tools that my firm has been using for a long period of time, tools that individual investors can use very easily in their own investment practice. The one tool focuses more on the longer-term trend of the stock market, i.e. the trend that typically lasts 8 to 12 months. And the second tool that I'll be looking at is more of a shorter-term market indicator that, for my money, is the best tool I've seen. As Rose said, I've been in this business for 30 years. For giving you a snapshot of market risk on a 3 to 6 month basis. So we'll look at long-term and then short-term, and then we'll segue into the part that everybody always comes to is stock ideas. You know, one of these days I'm going to get up here, skip the first two parts, and just spend 45 minutes shooting out stock ideas, because that's when everybody wakes up and the pens come out, and then, you know, so we'll get to stock ideas and we'll talk about those, and then finally I'll answer any questions you might have regarding the stock market. So, how now the Dow? My firm has been using a tool to discern the primary trend of the stock market called the Dow Theory. The Dow Theory is a tool that was first developed by Charles Dow, who was the first publisher of the Wall Street Journal back in the 1890s. It's a theory that looks at two things and two things only, which is one of the reasons I like it. It's a very simple tool to use to try to discern, again, the primary trend, not the day-to-day or the week-to-week, but the trend that should really matter to investors, that being the trend that typically lasts 6 to 8 months or considerably longer. The Dow Theory looks at two things and two things only: the movement of the Dow Jones Industrial Average and the movement of the Dow Jones Transportation Average. Now, I know many of you are familiar with the Dow Jones Industrial Average. It's typically the average that people quote when somebody said, "How did the market do today?" You know, professional investors tend to use the S&P 500, but at the end of the day, you know, the index of the masses is the Dow Jones Industrial Average. So the Dow Theory looks at that, but it also looks at the performance of the Dow Jones Transportation Average, which is an index that a lot of investors really ignore. And I think you ignore what goes on in the Dow Jones Transportation Average at your own peril. Indeed, to me, it is the single most economically sensitive index there is, even more so than the Dow Jones Industrial Average. The Dow Jones Transportation Average consists of 20 companies, shippers, truckers, airlines, companies that are very sensitive to a number of economic inputs, companies very sensitive to the overall economy. So what Charles Dow's theory was all about is that, listen, in an economy that's really in sync, an economy that's really hitting its gears, the industrials, which represent the companies that, to simplify, make stuff, and then the transports, which are the shippers of the stuff. What you want is an economy that's in sync, and both of those things in sync. If they're not in sync, that does not necessarily bode well for the economy. So there's a fundamental basis underlying the Dow Theory, and it's a simple basis that says, listen, an economy that's in sync has both of these two very critical components of it that are in sync. Well, what does in sync mean? Well, in sync means when you're looking at the performance of these two indices, what you want to see are those indices confirming one another in terms of their direction. And hopefully, in the sense of a bull market, confirming one another going higher, which is exactly what you've seen throughout this chart. It goes back to 2010. If you took it back a little bit further to that period of March 2009, when the market bottomed out after the crash of 2008, what you would see is a pattern that's pretty similar. You'd see a series of pretty much higher highs punctuated by these declines, with the market then going back above that previous high, a decline, market going back above the previous high, decline, market going back a previous high. And you see something similar to that in the Dow Jones Transportation Average. Admittedly, back in 2012, there was a fairly extended period where the transports were a little out of sync with the industrials. Not dramatically, but a little out of sync, where you had the industrials moving higher. That wasn't confirmed necessarily by the transports, but that was resolved at the beginning of this year when the transports had this real nice breakout above their previous highs, confirming this move in the industrials. So the long and the short of it is, when you look at the market from a purely Dow theory perspective, you can't read any other interpretation, but this is a bull market. You've got higher highs in both of the indexes. You've got both indices after about a 5-year wait going to all-time highs in 2013. And those highs were also accompanied by new highs in some other prominent indexes, such as the S&P 500, the Russell 2000. So you had a market which is demonstrating tremendous breadth and moving higher, not just the industrials and transports, but also in other areas, small caps, large caps, et cetera. So this is a bull market. So at the end of the day, the Dow theory says we've got a bull market. So if you were in any doubt whether this market trend is bullish or bearish, Dow theory says it's bullish. The last major signal under the Dow theory is bullish. So that trend, typically that long-term trend right now, is a bull market. Now, some of you may be thinking, well, what does that mean in context of what we've seen this week in the market? We've had a market that this week, for the first time, has buckled a little bit. Okay, not much. You have a Dow Jones Industrial Average. It's come down a little bit. It's interesting to me. I've been in the business for 30 years, and I can't tell you a time I've ever seen individual investors as skittish as they are today. And they're skittish because 2008 still looms in everybody's minds. Okay? Nobody ever wants to take another hit like 2008. Unfortunately, I think a lot of investors have focused their investment program based on the possibility of having another 2008, and that has cost them dearly in terms of what the market has done. But interestingly, I've gotten calls this week from clients that are very nervous about the market. The market's gone down 4 days. Now I have to remind them, yes, but it went up pretty sharply for 5 months, and markets give back gains. You need corrections in bull markets. It's kind of a necessary evil. Nobody likes them, but the fact of the matter is, to sustain a bull market move over a several-month period, you need something that takes the speculative fervor out of the market, that restores values, that skims the froth. That's the purpose of corrections. The purpose of a market correction is, in a nutshell, to scare the heck out of you. And we're probably in the midst of one that is going to scare the heck out of people, and I'll talk about what you can expect to see in a moment. So we have a bull market, longer-term trend. Well, what does the short-term trend of this market look like? I have before you not your EKG from 2008, 2009, or my EKG from 2008 and 2009. Rather, I have up here a tool that we call the Intermediate Potential Risk Indicator. Okay, it's a long-winded way of saying, what's the risk in this market on the short-term basis? Short-term meaning 3 months to 6 months. And what we've plotted here is one data point and one data point only. Again, I'm a believer in really simple tools because simple tools are easy to use, they're cheap to find, and they generally bring a nice clarity and perspective to the investment process. So this looks at one data point and one data point only. And any of you that have heard me speak over the years know I refer to this chart a lot because, to me, again, this is the money chart. This is the chart that's going to make your trip here tonight worthwhile, and it's one everyone can use, and let me explain it. The data point we look at is the percentage of stocks on the New York Stock Exchange that are trading above their 200-day moving average, okay? The percentage of stocks in the New York Stock Exchange trading above their 200-day moving average. Well, that sounds like a lot of mumbo-jumbo. What exactly does that mean, and why should I care? I'm kind of a believer in this mathematical concept called reversion to the mean, that in simplified terms it says, listen, in the short run, things can kind of move to extremes. But over time, things tend to migrate back to some equilibrium level, some golden mean, if you will, okay? Think weather patterns. I just came from Chicago this morning, and it is a bad scene up in Chicago weather-wise today. We were very fortunate to get out this morning. There's tornadoes rolling through. There's rain. I think one of the fellows I work with got 9 inches of rain in his basement today. So it's really bad. Well, that weather pattern in the short run is really bad, but it's not going to persist for 2 weeks or 2 months or 2 years. Why? Because it takes too much energy to sustain those bursts. Once that energy dissipates, the weather pattern will migrate back to some equilibrium level, some golden mean. Think human emotions, you know. We tend to live our lives at some sort of steady state. Now, your steady state may be different from my steady state, but typically we live our lives at some golden mean or some equilibrium, although it's punctuated by periods of these extreme stressors, you know, births and deaths and new jobs and job losses, et cetera. But we don't live at those extremes. Why? We'd be exhausted. They take too much energy. So once that, you know, we find our groove back, so to speak. I think there's an element of this in stock prices. Now, I went to the University of Chicago, which is kind of this bastion of efficient market theory that says, you know, basically everything is already reflected in stocks. And the price of a stock is the price it should be based on everything that's known in the markets. I kind of believe that to a certain extent, but I've seen enough over the years to say, boy, things can sure run to extremes in the short run, okay? This is a measure that tries to gauge that. Why do I look at a stock's 200-day moving average, and why do I care about the percentage of stocks that are trading over their 200-day moving average? Well, if I'm trying to get a sense of a stock's equilibrium level, okay, a 200-day moving average does a credible job of serving as a proxy for a stock's equilibrium level. Because to get a 200-day moving average, you're looking over a fairly extensive period of time. To get a 200-day moving average, what do you need? Well, first you need 200 trading days. And then you take that average, and that's a point on the line. To get the next point, you drop a day, you add a day, take the average, and so forth. So when you're looking at a stock's 200-day moving average, and it's very possible to do that nowadays online at any number of sites if you want to pull up a stock's 200-day moving average. When you're looking at that, it represents a reasonable proxy for giving you some equilibrium level for a stock. Again, it's not perfect. None of the indicators I'll talk about tonight are. What you try to do as an investor at the end of the day is gain perspective on a market environment. I think too often people in my shoes try to take tools and then apply them with this kind of laser-like precision that really is not what the tools are all about, especially something as imprecise as trying to predict the future, which is really what investing is all about, which if you think about that too hard, you know, too strong, none of you would be here to listen to me. So what you're trying to do is get some perspective on things, and you can use that perspective then to try to gauge how much risk you want to take in the market, where you may want to tilt your portfolio between stocks and bonds, et cetera. It's not going to tell you all the answers, but at least it gives you a framework, because so often individual investors tend to feel like a leaf in the wind blowing around, and it tends to feel that way, especially during very volatile market periods, like the 2008s, like the early 2009s, when you just, you know, you've lost all bearings and things are doing things that you never saw happen. To have tools like this are quite helpful. So what this chart shows is the percentage of stocks on the New York Stock Exchange that are trading above this equilibrium level, okay? With the idea that more and more stocks trading above this equilibrium level, if reversion to the mean is eventually going to kick in, you would expect some migration eventually down toward that equilibrium level. So it's kind of a popularity index. When you have lots and lots and lots of stocks trading above their 200-day moving average on a short run, that's kind of an indication that stocks are extremely popular, maybe a little pricey, risk in the market is higher. We quantify that level of lots and lots by saying anytime the percentage of stocks gets above 70%, we classify that as higher risk in the marketplace, okay, for the next 3 months or so. Anytime it drops below 40%, we classify that as lower risk in the market for the next 3 to 6 months. Now, like any tool like this, my recommendation is not necessarily the minute it falls to 39%, that, boy, that Carlson guy said it's a screaming bull, go out and back up the truck. Nor, if it gets to 71%, you ought to be dumping everything you own. Typically, this chart works best kind of at outlier positions. So, if you start seeing the percentage get above 80, that's where I really start to kind of get concerned. Likewise, if you see that percentage drop below 30 into the mid-20s or even below 20, that's where, I think stocks are really, really screaming value. So that's kind of how I use this. And again, I don't use it in an all or nothing way, in a sense that percentages at 75, I'm dumping all my stocks and getting out of the market. Our firm doesn't do all or nothing market timing, even though we have tools that we've been using for a long, long time, and tools that I think are very good. The fact of the matter is, no tool is perfect. And the problem with all or nothing market timing is you might get lucky a time or two, but you're not going to be able to do it consistently. And the risk you run of being out of the market when the market takes off is far greater than riding through some of the ups and downs in the market. So we don't do it. What we try to do, again, is use tools like this to tilt our allocations at the margin, or to give us some guidance in terms of how aggressively we should be putting new money into the market. So, having said that, let's look at this chart for a moment. And let's go back in time a little bit to see how this has done over the years. Let's go back here into the fall of 2001. As you can see, in the fall of 2001, the percentage of stocks on the New York Stock Exchange trading above their 200-day moving average fell all the way down to about 19 to 20%. Up to that point, and my firm's been tracking this since 1989. And I'll show you, by the way, where you can find this data point every day for the price of a daily paper in a moment. So, we had been tracking it since 1989. That was the second lowest total we had ever seen. Can anybody guess what might have happened in the fall of 2000? 9/11, that's right. So if you remember what happened, you had the event, the market closed for 3 days, I want to say. When it opened up, what happened? Shoot, it tanked. Well, hindsight, given what happened in the market in 03, 04, 05, 06, 07, all up years in the market, this would have been a really nice time to go in and buy stocks. How many of you had the courage to go in after 9/11 and buy stocks? They were cheap, right? Buy low. It generally doesn't work that way, does it? Most of us try just not to buy high. And we don't generally do a very good job of that either. One of the reasons is it's very hard to go in and buy when stocks are really cascading down. Now, let's see what happened. Let's say you would have bought here in the fall of 2000, or 2001, excuse me. Well, if you remember, the market bottomed, then you had a little bit of a rally into early 2002. So you were probably feeling pretty good, saying, boy, that Carlson guy knows what he's talking about. And then what happened in 2002? Shoop. The market really took a tumble. Came back to these levels. So now, anybody who bought here is really saying that Carlson guy is a complete idiot. But had you bought here, you may not have been instantly rewarded, and you were probably early, and yes, you had to ride through some ugliness in 2002, but I'll tell you what, you were awfully glad you did, given what happened in 03, 04, 05, 06, 07, all up periods for the stock market. So, bottom line is, this is providing a perspective and giving you some relative feel for market value. Again, it's not designed to pick an exact bottom in the market, although it tends to do a pretty good job about that. But it's more designed to give you some perspective on risk so that you have something to gauge, boy, maybe I should be buying in here. Stocks can go lower, and we'll see that in a moment. But I know this is a pretty good value place. That's why building into an investment program something that forces you to buy in these periods is a good thing. That's really the strength, in my opinion, of plans like 401k plans, okay? If any of you are still in your 401k, yeah, you get, massive tax benefits, et cetera. But one of the things you get is you're putting money into the market right here because that money's coming out of your paycheck every period, okay? Granted, you're probably cursing that money coming out of your paycheck and buying here, buying here, buying here as it comes down. But at least you took advantage of that. Another way people do that is dividend reinvestment, which is a topic that's kind of near and dear to my heart, and I'll talk about it in a moment. But if you have dividend reinvestments set up in your stocks, whether it's at your broker or you're actually in company dividend reinvestment plans, you're reinvesting those dividends every 3 months. So it's this automatic mechanism that you don't have to think about, that emotion isn't going to kick in and stop you from doing, that forces you to buy. So 2001, we got down here. Good time to buy. You weren't instantly rewarded, but you eventually were. Let's fast forward now to, that's right, 2008 and 2009. To get a sense of just how bad the markets were and how out of favor stocks were, at the end of 2008, beginning of 2009, only 2% of the stocks on the New York Stock Exchange were trading above their 200-day moving average. 98 out of 100 stocks were trading below this equilibrium level, okay? Obviously, you couldn't go much lower than that. Now, let's say after the market buckled here, got below 40, got into that range I said, 20, 25, 30, and you thought, you know what? I think Carlson's onto something with this thing. I'm going to go in and buy stocks. Yeah, I know they're cascading downward. I know the world's ending. I know banks are going to go bankrupt. I know everything is awful, but I'm going to go buy some stock right here. Well, what happened? Well, you were early. The market just blew, tanked, and now again you're saying, gosh darn it, I can't believe I listened to that knucklehead again. But what happened here? 2008, after 2009, the Dow fell to roughly 6,500. The Dow Jones Industrial Average was cut in half in that period right here. 50% decline. Stocks are on sale. Who's with me? Who's buying? You're probably more likely to sell, unfortunately. There are people who sold right here. I can't take it anymore, Chuck. I got to get out. Well, they just locked up a massive loss. Then the market took off. Now, obviously, it would have been great to buy here, and if you were dividend reinvesting or 401k or something that forced you to put money into the market, you were doing it here. But let's say you bought here. Did it work for you? Sure did. I wish I'd have bought a ton here. Because what happened? Well, the markets kicked off, and then you had a strong 2009, strong 2010. You had a slight up move in 2011, and you've had a real strong, nice market so far this year. So again, you didn't pick the bottom, but you used this as a perspective that gave you some idea about risk in the market. And you said, you know what? I don't know if stocks have bottomed here. But I know using this tool, I could feel pretty confident that maybe they're not at a bottom, but they're offering a pretty good value relative to history. You know, what's interesting, if I talk to people and they talk about the general market, and most people will say, geez, you haven't been able to make any money here in the stock market, have you? Again, anchoring on what's going on in 2008 and 2009. If I asked you, over the last 11 years, and I'm including 2013 in that, so over the last 11 years, how many of those 11 years was the S&P 500 showing a positive total return for that calendar year? What do you think? I don't know. It feels like 3, 5. The answer is 10. 10. 10 out of the last 11 years. Now, 2008 was a doozy. But, it's not like stocks haven't been going up through that period. If you go back to 1926, on average, stocks go up 3 out of every 4 years. And that includes the period around 2008. That includes, 1987's crash, 1989's crash. 1987, the Dow fell in one day. Steve, how much did it fall?
Was it about 2,000 points?
It fell 20%. in a day. One day. A 20% decline today from the levels we're at now? I can't even do the math. What is it? 2,800 points in a day. And yet, that year, if you looked at the calendar year, the S&P 500 actually showed a positive total return in that year. So, long and the short of it is, yeah, markets have their risk. There's no doubt about it. And obviously, as one gets older, the ability to absorb that risk is tougher. But don't shortchange your investment time horizon, and don't anchor on 2008, and don't base everything on what you do on something that I think is going to turn out to be a once-in-a-70-year event, quite honestly. So let's fast forward. What's this market tool saying right now in the market? Well, we've had this nice move in 2013, coming off a nice decline toward the end of 2012. As you can see, it dropped here below into lower risk. We had this spike up to about 85%. It's worked its way back down a little bit on April 12th. So that was, let's see, when was April 12th? Friday. It was 75%, okay? So it's still above now this higher risk area. I checked on it today through yesterday's close, and it was down to 66. So it's starting to work its way back down. After today, it's going to be lower than 66. But the long and the short of it is, if you're looking at this tool and you're trying to get a sense of the risk in the market, the likelihood that we'll see some pullback in stocks in the short run, this is indicating that, yeah, wouldn't be surprising to see that. We had a pretty nice rally. We've had stocks that seem to have gotten a little bit ahead of themselves. And to have this market pull back, it seems like it's due. The other thing and reason why I think you're going to see a little bit of a pullback here, and I'll quantify what that pullback amount can be in a moment, is, and this doesn't show up very good on this chart, but one of the tenets under the Dow theory I mentioned is this notion of confirmation. What you want to see are both the Dow Jones Industrial Average and Transportation Average moving higher, hopefully both of them making new highs and confirming one another. What we've seen in the very recent past has been a little bit of divergence between the industrials and the transports. Indeed, here, we've had the industrials continue to move higher, and we've had this pullback in the transports. Again, I don't want to make a mountain out of a molehill, but while the industrials have continued to move higher and have been making a series of all-time highs prior to the last 3 or 4 days, the Dow Jones Transportation Average peaked out March 14th. So we're about a month into this divergence between the industrials and transports. And again, divergence can be kind of if not a red flag, at least a yellow flag for the market. And divergence has a precedent of creating and setting up some of these secondary corrections in the market. So we have this divergence here that's a little worrisome for the short-term trend. And then you couple that with this percentage reaching, into the mid-80s, pulling back, but still having a little bit more room to go. The long and the short of it is, long-term trend of this market, I still believe is bullish. Shorter-term trend, I think you're going to see a correction in this market, probably a continuation of this downtrend. So, how deep can this correction go? Well, the Dow theory does a real nice job of quantifying corrections within bull markets. Basically what it says is typical corrections in bull markets, and I use that phrase correction. Basically a correction means a drop in the market, okay? And a secondary drop. It's not a primary drop. I don't think it's the beginning of a bear market, and there are a number of reasons why I don't think that. I just don't see the investor ebullience that I typically see at significant market peaks. I'm still seeing stocks out there that I think offer reasonable valuations. The level of skepticism, I think, is still significant. There's still many people that are concerned that don't believe, et cetera. So I don't think we're getting into the beginning of a bear market. I think it's more of kind of your vanilla, run-of-the-mill corrections that you need to sustain the next up move. So the Dow theory says typically corrections will retrace 1/3 to 2/3 of the previous advance since the last correction, bottom. And those will typically last 3 weeks to 3 months. So corrections, again, in the market, and I would apply those terms to this market because I think it's a correction within a bull market. I think this correction, and I think we're beginning it, will last anywhere from 3 weeks to 3 months, and will retrace 1/3 to 2/3 of the previous advance. So what does that mean in points on the Dow? Well, this level on the Dow here was the last low, the last significant correction low, was around 12.5. So the market went from 12.5 to 14.8, the Dow, 12.5 to 14.8. So that's what, 2,300 points, okay? Think about that, 2,300 points the market went up. So when somebody's talking about, gosh, the market went down 100 points today, you know, you're spoiled. So what's 1/3 of 2,300? 700, 800 points. What's 2/3? 1,400 to 1,600 points, okay? So you could have a Dow, if it falls 700 to 800 points from the peak of 14.8, that brings it down to somewhere around 14,000. A more significant correction would bring it down to about 13.3, okay? So if somebody says, okay, Chuck, what do you think's worst case in this market? I think worst case in the Dow is about 13.3, and worst case it's going to last about 3 months, okay? Now, do I think we're going to see the worst case? I don't. One of the reasons for that is I think any correction, we get a correction that gets back to 14,000, it's going to do what corrections are supposed to do. It's going to scare the heck out of everybody in this room. Because what are they going to think about? Oh man, here comes 2008 all over again. So I just don't think you're going to see a market get that far down. I think it's probably going to bottom out here at 13.8 to 14,000 if I had to pick a number. But if it got lower than that, it could go to 13.3 and still be a correction within a normal pattern under the Dow theory. The transports would do a similar decline in terms of duration. It will last 3 weeks to 3 months. We moved from about 5,000 up to about 6,400 in here. So that's 1,300 points. You'd see a pullback in the transports of, you know, anywhere from 400 to 500 points upwards to maybe about 800 points. So a move from, 6,300 down to maybe 58, or somewhere maybe down to about 53. So that, if you're an investor and you're trying to calibrate maybe what you're looking for in terms of thinking about putting money into the market at some point here, those would be kind of general broad levels I'd be looking at in terms of a worst case for this market. Again, on the Dow, that's about 13.3. I think it's probably going to be closer to 14, and again, last 3 weeks to 3 months. So, and then, more importantly, after you have that decline, my expectation would be, because I believe it is still a bull market, that the market will resume its upward trend, and eventually eclipse this previous high in both the industrials and the transports. So, long term, I'm bullish. Short term, I'm a little concerned. You could see some weakness in the market. Is it weakness? Is it something that I'm recommending people go out and trade? Oh man, let's dump all our stocks. The answer is no, because I could be wrong. And if you're wrong and the market just continues to move higher, you're going to be chasing your tail for a long, long time. Should you maybe tilt something, or if you're thinking about putting money into the market today, do you want to hold off a little bit, see what happens here based on this? Yeah, I think that's fine. But don't be a hero using this tool, the intermediate risk, or any market tool, because, being a hero. The worst thing about market timing is, the absolute worst thing is, the first time you do it, it's like going to Vegas. You're going to get it right. And then what happens? Then you're a genius. And then, it only takes one time getting it wrong. That's the problem. You can have a lot of, that's why, day traders, God love them, if you can make that work, fine. But, anytime you're moving money aggressively into the market and out of the market with a high degree of frequency, it requires humans to be right a lot. And we're not. And just kind of keep that in mind. If you think you're going to get it right, and you got to do it successfully, because you can be right the first 9 times, but the 10th time you're wrong, it can undo all the other times that you were right. So this is what we're seeing in the market. Now, I told you, you can find this data point to chart the intermediate potential risk is available every day in a newspaper called Investor's Business Daily. You can buy it at the newsstand. I don't work for Investor's Business Daily. They don't know I exist. I'm not a shill for them. It's the only place I've ever found that lists it every day. And you can find it. They list it pretty much every day on page B as in boy 8. On Mondays, they make you fish around for it, but virtually every other day, page B8. When you go to page B8, up in the upper left-hand corner, you're going to see a series of small charts. And one of those charts is the NYSE composite. And on that chart, in the same place, they'll list the percentage. They don't circle it for you. You know, they don't make it that easy. I did that for you. But you can get it for the price of a daily newspaper. So anybody in this room can chart it. It's a very easy tool, very simple to use, and I think it has a great deal of power. So let's get to the stock ideas. My firm uses a tool called Quadrix to help us ferret out stocks that represent good opportunities. And in a nutshell, Quadrix is a stock rating system we developed that ranks more than 4,000 stocks. And for each of those 4,000 stocks, we're scoring the companies based on more than 80 different variables. So it's kind of this big black box that scores and weights and ranks a lot of stuff, both fundamental as well as technical indicators. And then we're looking for stocks that are scoring well, not just overall, where we add up all these things, but also scoring well in value and operating momentum and earnings estimates. So we're trying to find stocks that have it all, literally, that have a breadth of performance, that are getting over a lot of hurdles. Is Quadrix perfect? No. It does a pretty good job of ferreting out companies, and maybe more importantly, helping you stay out of lousy companies. And I think that may be a secret to investing for all of us. You know, we all like to talk about, you know, those stocks we bought at $2 that went to 50 and brag about it. The fact of the matter is, those are hard to find. And most portfolios, and I see a lot of them over the course of the year, would do a whole lot better if they just did a better job of keeping junk out of a portfolio. Because I guarantee you, if I went through a lot of the portfolios in this room, what I would see is, let's say you got 15 stocks. You probably have 3 of them, you have no idea why they're in there. They do poorly, but you know, your brother-in-law told you to buy them, and they're in there because you forgot about them. Then you probably have 6 stocks in there, 7 stocks, maybe 8, that are decent stocks, pay good dividends. They're never at the top of the leaderboard, but they never tank on you. They're easy holds, I call them. They do okay, maybe plus or minus what the market does. And then you got those 2 stocks that basically 80% of your portfolio is in, that you bought in 1985, you held on to them, you put money into them, and they took off, and that is the stocks that made you wealthy, okay? They're hard to find, and if you could just keep some of the junk out of the portfolio, we'd be way ahead. Our Quadrix has done a credible job of isolating those companies that have performed pretty well. This chart is not a model. It's based on actual scores of the 4,000 stocks broken down by quintiles. In other words, stocks that score 80 to 100, the top quintile, et cetera. And what you can see is this dark blue represents the highest scoring stocks in Quadrix. And for the most part, going back to 2000, where we started Quadrix, it's performed quite well. Now, there are periods in here when Quadrix hasn't performed quite well, and those periods are earmarked by a thinning of this blue line, blue gap, over the other areas. And one of them was 2008. Interestingly, nothing worked very well in 2008. It was a seller's market. Basically, if you go back, the thing that was interesting about 2008, unless you had your money in cash or government securities, you lost money. It didn't matter if you had it in large cap stocks, small cap stocks, value stocks, growth stocks, international, gold, come on, everything, because it was a seller's market. It was just a massive liquidation. Everybody was calling in debt. People were getting off margin. It was a mess, and so it was atypical. So we didn't do it very well in 2008. There weren't many people did, other than if you were lucky enough to have your money in cash. But in the main, it has done a pretty good job of giving us some idea of stocks that represent opportunities. So let's get to the stocks. The first sheet I have here, and again, you have a handout, so you have all this on your handout. I apologize for the micro print on the handout. I was trying to save space, and going to inflict all of your eyes with some stress. But what I have up here are some of our company's current favorite growth and income stocks. Growth and income investing has become really the sweet spot for investors right now, okay? Dividends, dividends, dividends. People like dividends. They want to buy dividends. They have to get cash flow because they can't get cash flow anywhere else right now. They can't get it from the bank. You know, good luck buying a bond. You know, you buy a 10-year treasury and it yields 1.6%, so congratulations. You just locked up a negative after inflation return for yourself for the next 10 years. So they're searching for places to generate income. And interestingly, you can get yield now in stocks on a relative basis compared to fixed income investments. Here are some of our favorite growth and income stocks right now. Some of these names may be familiar to you. Probably most of these names may be familiar to you. There are a couple of stocks in here that are somewhat controversial. I don't know if you're familiar with a company named Apple. We like Apple. It's an idea that hasn't worked very well for us. It worked fantastic for us last year. It hasn't worked for us at all this year. Apple's down, I think, 24% so far this year. We still like it, okay? Apple's a tough stock. I will admit it has all the classic features of that value trap. It's a stock you look at and you give a valuation, and Apple's trading at 8 times earnings. It's got, you know, more cash than, you know, half the universe in terms of what it has. It's got products that people seem to like. It seems to have everything going in its favor. But right now, Wall Street's selling it, okay? And those tend to be scary stocks. Again, I don't disregard what the market says about a stock too often, okay? I am in the case of Apple. Maybe I'm going to be proven wrong. One of the things I think you're going to finally start to see some support come into Apple is this right here. You know, and that was based on $4.30 price. Apple today went below 400. So this is now probably closer to 2.6, 2.7. Plus, you know, the guys at Apple are sitting there going, wow, this is a drag. You know, I think Apple has some options to do some things that could be positive for the stock. One of them is if they decided to share some of that wealth with investors in terms of dividends. So, you know, again, is Apple set to skyrocket here? I don't know, probably not. Do I think it's pretty good value here? Value driven by this? Yeah, so I'm willing to buy the stock at these prices. Some of the other stocks, some names, you know, CVS might look a little odd being a company that's on a growth and income with only a dividend yield of 1.6%. But I think investors should not ignore those companies that are in the 1.5% to 2% range when you're looking for dividend-paying stocks. And one of the reasons is not only yield matters, but dividend growth matters, especially if you're somebody who tends to hold stocks for a period of time. And so we look at dividend growth as a significant thing, almost more significant than current yield in a lot of cases. CVS is a company where you're going to see really nice dividend growth coming out of that stock. They raised their dividend 38% in the first quarter of this year. You're going to see continued dividend growth. I like drugstore stocks right now, and they also have a pharmacy benefit management company. You know, CVS and Walgreens are both pretty interesting stocks to me as ways to kind of play this changing world of healthcare. And they're also stocks that tend to be in kind of the market sweet spot right now, where investors feel comfortable putting money into kind of brand stocks, so to speak. So I like CVS quite a bit. The last stock I'll mention is, again, not a stock that springs to mind as a typical growth and income stock because it's a technology stock, but it's Qualcomm, the chip maker. Again, Qualcomm just boosted its dividend 40% in the first quarter. They have $28 billion in cash and investments on their balance sheet at the end of 2012, and they don't have a spot of debt. They have an annuity-type business because they generate virtually every 3G phone in the world pays a licensing fee to Qualcomm. So they have this annuity stream generated by their technology. Is it a kind of an aggressive stock right now in this environment where technology is out of favor? Probably. But again, I get a nice dividend yield. I get earnings growth. I'm getting good dividend growth, and it's a stock that I feel comfortable with. I'll jump to the next slide. Favorite utilities. Utility sector may have been, I think, the single best performing sector in the market in the first quarter. The S&P 1500 utility sector was up 13% in the first quarter. It did better than the S&P 500. It did better than the Russell 2000. People like utility stocks right now. Why do they like utility stocks? Okay? Now, I will grant you, they're a little spicy meatballs right now, okay? People are buying utility stocks because A, of the yield, and B, they tend to have defensive characteristics, and they do typically. But they've also been bid up to some pretty interesting valuations when you start looking at utility companies, which by and large are low growth or no growth businesses, okay? So, while I think there's opportunities in utilities, why I think having exposure to utilities makes sense, would I be betting the farm on utility stocks right now? I probably wouldn't. But if you are looking for ideas in the utility space, these 13 stocks represent our favorite utility stocks right now in the market. Okay? Again, you'll see some in here that may have some yields that are a little bit on the lower side for utilities. We're willing to take that lower yield as a trade-off for better dividend growth. But in the main, these are our favorite utility stocks right now. MLPs, master limited partnerships, another area people have been flocking to, another area that has done exceptionally well. Why? Dividend yield. Again, another area that might be a little overpriced right now. But if you're looking for ideas in the MLP space, the two that our firm owns for clients, and they've done quite well, are Plains All-American Pipeline and Sunoco Logistic Partners. The last series of slides I'll show, and then I'll get to your questions. As I mentioned to you, a subject that's near and dear to my heart are these companies that offer dividend reinvestment plans. What's a dividend reinvestment plan or a direct purchase plan? These are programs that allow any investor in this room to buy stock directly from the company without a broker, your first share in every share of stock. The minimum initial investment in over half of these plans, and there's over 300 U.S. companies and a similar number of foreign companies that trade on U.S. exchanges, where anyone in this room can buy stock directly, your first share in every share. Minimum initial investment for the majority of these plans is $250 or less. So, you have a youngster, you have a grandchild, you want to stop buying them that video game for their birthday, and you want to get them on the road to investing, check out these programs. And I have a list of just a sample of the companies that offer these plans. AbbVie is a company that was recently spun off from Abbott Labs. Interesting stock, actually. It pays a nice dividend yield. And this is just kind of to give you an idea of the flavor of the companies. I don't know. We're in Florida. You may have heard of this. Exxon, Harley-Davidson, IBM, Intel. Over 20 of the 30 stocks in the Dow Jones Industrial Average allow any investor to make even their initial purchase of stock directly. How do you get the enrollment information? You get it by calling these numbers, going to the company's website. You download the enrollment form, you fill out the enrollment form, you cut your check, you send it off, and you're up and running. Some of these companies, in fact, most of them will allow you to make investments online if you prefer to do it that way. Once you've made that initial minimum investment, and I have that listed here, subsequent investments at your option, in most cases, are as little as $50 to $100. So, in Exxon, for example, Exxon stock, minimum initial investments, $250. Subsequent investments are $50. Well, wait, Exxon sells for $88 a share. You mean I'm buying a fractional share? Yeah, you're buying a fractional share, and that fractional share is entitled to a fractional part of the dividend. So you're buying stock on the installment plan, which is kind of neat. Exxon doesn't charge you a penny, by the way, to participate in the plan on the buy side. So all of your money goes to full and fractional shares. So again, I put a sampling here. If you want a complete listing of all the companies that do this, U.S. companies, you can get one free off my website. It's www.dripinvestor, not a reflection of the editor, dripinvestor, dripinvestor.com. Before I throw it over to questions, I have two questions for you. I brought two in my latest book, and I'm going to ask you a question. Do not shout it out. I wrote a book a few years ago called Winning with the Dow's Losers. The book's premise was the worst performing stock in the Dow one year tended to do pretty well the following year. Again, this concept of kind of reversion to the mean, where you had a stock that just gets decimated one year tends to kind of have this snapback, okay? And I went back to 1930, did an analysis, and it's a strategy that works pretty well. Doesn't work in every year, but it's a strategy that works pretty well, and it's worked very well in the last couple of years. So, of the Dow Jones Industrial Average, and raise your hand, tell me, what was the worst performing stock in 2011 that turned out to be the best performing stock in 2012? Yes, sir. Hewlett-Packard? No, Hewlett-Packard was not. Yes. Cisco was not. Yes. Bank of America. Congratulations. Bank of America got creamed in 2011. That book is signed, by the way, so it's worth, according to the bank, it's worth about 16 bucks. The Bank of America was up over 100% last year after getting decimated in 2011. The strategy has worked well so far this year. Tell me what the worst performing stock was in the Dow in 2012, which so far this year is the best performing stock year to date. Any guesses? Yes. Hewlett-Packard, that's correct. Yeah, Hewlett-Packard's by far and away the best performing stock in the Dow so far this year. It's up about 43%. Yeah, it's actually had a really nice snapback. Now I think it went down 43% last year, so you get this bounce back effect. With that, I'll throw it open and take some of your questions. Yes, sir.
Thank you. With the dividend reinvestment plans, I'm curious as to what is the origin of the stock? Are they coming off the company's treasury stock, or are they being bought on the open market? And if so, how is the stock price determined?
That's a great question. In other words, you're buying stock from the company. Where does the stock come from? It can be either companies issuing new shares. Because some companies, you may be wondering, why does a company offer this program in the first place? What's in it for the company? Well, I heard the word PR. That's right. A lot of the companies, McDonald's has one of these plans. Well, McDonald's hopes, if you're a shareholder in McDonald's, you're going to buy a Big Mac instead of a Whopper next time you go fast food shopping. But there are also companies that offer these plans in very capital-intensive businesses, such as real estate investment trusts. REITs are always going out and they buy real estate, so they always need capital and utilities. And what they will do in that case is basically they are self-underwriting stock offerings by issuing new shares that they're selling to individuals like yourself, and then they're taking the money and using it for corporate purposes. There are other companies that don't need the cash, don't want to issue new shares, so they're taking that money and then going into the market for you and buying stock in the market. How they're priced, and the pricing is spelled out pretty clearly in the prospectus that you'll get with the enrollment information. Typically, companies will buy for you within 5 days of receiving your payment. So the downside of these plans is you don't have the precision over the buy and sell price that you have by going through a broker. The upside is if you're somebody using the plan as more of a long-term investment tool where you've determined, hey, this is a nice core holding for me, and I just want to accumulate stock over a longer period of time, whether you buy it a quarter higher or a quarter lower than the market at that point is probably immaterial. So, yes. Yes, sir, way in the back.
How do you feel about the financial stocks? You mentioned Bank of America coming back up. What about moving forward from today? A specific stock, Caterpillar, another one that's kind of taken a beating. And lastly, I don't know if you want to comment on interest rates or not.
Okay, let me start with the last one first. Interest rates, I tend to get nervous when everybody has the same opinion on something, because generally the markets turn that on its head. And if there's one consensus opinion out there that everybody has, what is it? Interest rates are going to stay low. Now, I kind of think interest rates are going to stay low. But I'm a little uncomfortable with that just because everybody thinks that. And it doesn't require a lot for rates to perk up to really see damage in bonds. I heard somebody the other day, and I thought it was pretty clever. I think most people view bonds as risk. I'm going to get this. You get a risk-free return from bonds, right? Risk-free. Nowadays, it's more like a return-free risk. Did I do that right? Boy, I really screwed up that. And that was going to be my return-free risk. Yeah, I like that. Okay. So I'm a little nervous about it, but I don't think that's a problem for at least another 6 to 12 months. So I think rates are probably going to moderate down in these levels. The second question was Caterpillar. I think Caterpillar is a pretty solid company. It is definitely not in the market sweet spot right now. So if you're looking for returns over the next 3 to 6 months, Caterpillar is not a stock I think is going to give that to you. If you're somebody kind of weighing and saying, I think Caterpillar is a pretty good stock, pays pretty decent dividend, and this is a bull market, then would I buy Caterpillar here? I might, but I'm looking more at 12 months as opposed to 3 months. Financials, I think there's some opportunities in selected banks. We have buy recommendations on JP Morgan and Wells Fargo. We also have a buy recommendation on US Bank. And then we have a couple of smaller banks, Cardinal Financial, which is a smaller regional bank. So we do like some banks in here. Another question? Yes, I'm sorry, yes.
My question is this. You've done very, very well on your utility fund thing. I've talked to you about that before, and I'm interested in putting money into it. But my question is, if interest rates start to turn up, which is a good possibility eventually, what are you going to do with those utility stocks? Because the yields are 3 or 4% when they used to be 6 and 7%, 10 years ago.
Well, again, utilities will be less attractive in an environment of rising interest rates. I kind of think there's a pivot point in there, and there's room for rates to rise some before it starts to impact utilities. I think, again, I often look at investments as kind of, you got to do something with your money, right? So I can put it here, I could put it here, I can put it here, I could put it here, I could put it here. I think utility, if I'm still looking for yield, I think utilities will still offer a better place early in that interest rate rise. Now, obviously, if interest rates start to skyrocket, it's not going to be good for utilities. What we're going to do in that environment is probably not a whole lot, in a sense that we have our utility strategy as a part of a broader portfolio for most people. So, if you have 100% of your money in utilities, that may not be the best thing anyway, even if utilities are doing well. But yeah, you should probably start to trim that back. But we generally have, for people that really are focused on income, are typically 15 to 20% in utilities is about where we're at, really. And that's probably not going to change. Maybe instead of 20, it goes to 15 if interest rates start to pop up a bit.
You also have like Next Era Energy and CMS that you've done fantastic with. Stocks are almost up 40, 50%. Are you going to trim those back?
Yeah, we evaluate utilities on an ongoing basis using our Quadrix model and things like that. And we have sold utilities in our portfolio. So yeah, if it comes to a point where it's not scoring well in our model, we'll sell it. So any other questions? Yes, sir, in there.
What is your opinion of AIG?
It's not a stock, quite honestly, that I follow very closely, so my opinion probably is not one that you should necessarily take to the bank. It's not, we don't recommend, maybe the easiest way is it's not a recommended stock of ours, so we're not buying the stock right now. Boy, I thought somebody would ask me about gold. Were you going to ask about gold? You know why? Because I slipped in a chart at the end of the PowerPoint. Yesterday, I'm in my office saying, you know what? I bet somebody's going to ask me about gold. Well, there's gold there. Boy, that's... let me answer the J.C. Penney. Retailing, if you're not at the high end and you're not at the low end and you're in the middle it's game over. So that's I think JCPenney's, it's like Sears, it's a wind down. I mean, people are going to look at JCPenney as they look at Sears. It's not a retail play, it's a real estate play. So I'm not buying the stock. Now, gold. Gold has obviously had a little bit of weakness over the last week. Is that weakness going to continue? Well, take my opinion of gold with a grain of salt, because I haven't liked gold for 10 years. And I've been dead wrong, okay? So, having said that, getting back to this notion of you got to put your money somewhere and assets, and you can put it in gold or you can put it in stocks. And to me, and I've thought this for, and it has proven to be the case at least, what's that, a broken clock is right twice a day. Stocks are a better opportunity than gold. And one of the reasons gets back to this whole concept of reversion to the mean. This is a beautiful chart. Look at the performance of gold as represented by the GLD exchange-traded gold fund, okay? That's one of the things that's made everybody a gold investor now. 10 years ago or 15 years ago, how'd you buy gold? It was hard, you had to go, it's just a pain. Well, when they've securitized gold by offering tools like this, now you can go buy gold, which to have a little bit of gold in the portfolio is fine. My problem I have with gold is that people who buy gold don't have a little gold in the portfolio. It is the portfolio. So, this concept of reversion to the mean. Look at the spread of returns going back to when the GLD started in November of 2004. Over this time period, even with the recent decline, the GLD is up almost 200%. The S&P 500 over that same time frame is up about 35%, 40%. Is this performance gap going to persist? I don't think so. Which means, one of three things have to happen. Gold comes down, stocks come up, or a combination of the two. I kind of think it's going to be a combination of the two. So, to answer the question that I posed to myself about gold, I think it's too early to be a buyer of gold. I would not buy it. And yes, sir.
I'm a little older than you, and I remember when I bought gold years ago, when gold hit 800, and then a couple months, a couple years later, it was 400, and then it dropped to 255, 260. So we're dealing with a commodity which is not different, and we're actually gambling rather than risking. I think any stock, any bond, that gold at $1,500, $1,600 today, which 5 years from now could be $275 or $300, is too big a risk, dollar-wise, in gain.
Yeah, well, I would agree. I don't know if we're going to see gold at 275, but I think, again, when you're evaluating between gold and stocks, to me, part of the problem I've always had with gold is I don't know what to do with gold. I mean, it lays there. It's almost like, what's the value? It doesn't pay a cash flow. So it's like when somebody says, well, is gold high or low? I don't know. And so, it really is, it is driven solely by supply and demand. Not that stocks aren't, but at least I feel like I'm in the game somehow trying to figure out a stock. Gold, it's very difficult for me to have a concept of it. So, which is why, I look at things like kind of relative spreads and say, well, should I put money in gold or should I put it in stocks? And this tells me, well, I think stocks are probably a better place to be.
Time for one last question.
I'll tell you what, sir, let me get somebody else inside.
I was making a statement the first time.
I agreed with it, too.
When IBM split off into loose ends, it climbed like the devil. It was after you were a pitchfork. The end result, it actually reached 160 or something like that over the years when I had 800 shares. So I can't cry. And then it suddenly came down to practically nothing. And then the French bought it, and they got 50,000 employees in Hong Kong and the China area, and it's practically, they say it's bankrupt, but it isn't. What happened to it? It's now worth $1 and change.
Yeah, well, I mean...
Somebody speculating with it, or they bleeding it off?
Alcatel-Lucent hasn't exactly been... I mean, there are three things that drive stock prices, okay? There's a million things that create day-to-day noise, but at the end of the day, when you take a step back and you're trying to get a sense of what drives stock prices is three things. It's inflation. Low inflation means higher multiples. It's interest rates. Low interest rates mean stocks are a better game in town than the alternatives, and corporate profits. If you look at Alcatel-Lucent's corporate profits, they've been horrible, and that's what you get when you get a $1 stock. One last question.
Yes, how would you compare like competing stocks? Caterpillar was mentioned earlier. How would you compare if you're looking between maybe Caterpillar and Deere?
Oh, that's a tough, I would, what we would do is use our Quadrix model and as a first starting point, how do they score in the model? And how they score in that model would have a fair amount of weight in terms of which one we would decide. And then we would look at things like industry, the type of industry exposure. I prefer Deere's industry exposure to Caterpillar's industry exposure where their primary markets are, so I would probably buy Deere in that case. But that's a tough one. I mean, they're kind of like sisters in a way. I don't know where I'm going with that comment, but I better stop while I'm ahead. Thank you, everybody. I appreciate you coming.